This conference will now be recorded.
Good afternoon and welcome to our fifth weekly webinar. My name is Marty Curtis, and on behalf of all the advisors at Provisions Wealth Planners, I'd like to welcome you again to our webinar. We've been working through the compliance maze to getting these recorded, these webinars recorded and posted to our website. I think that tomorrow we're going to have the recording from last week's session up. And will be posted in the content section of the website, and then it should be just a few days after the actual event going forward that we'll see those postings. With that, I'd like to introduce this week's guest speaker. His name is Erik Ristuben. He's the Chief Investment Strategist with Russel Investments. As the Global Chief Investment Strategist, Erik's responsibilities include the creation and management of integrated client investment strategies for Russel institutional and retail clients globally, as well as creation of Russel Investments global economic and market outlooks. In his role, Erik manages the global client portfolio manager team. That team works directly with clients on the implementation of investment strategies for both individual and institutional clients. As a senior member of the investment division, Erik serves as a member of Russel Investments Investment Strategy Committee and the Investment Risk Management Committee, which oversee funds management for Russel Investments' entire global funds complex. So, Erik, thank you so much for joining us. I know your schedule is very hectic and really appreciate you wiggling us in for the session today.
Happy to do it.
So we'll kick it over to you for your thoughts and insight. And then I do believe that you were given some questions that clients have posed to us, if you could address those. And then at the end of that, then we'll open it up for Q&A.
Okay, if I forget to address any one of the specific questions, just circle back and tell me I forgot. Sure. And I'll answer it. Sure. So, I mean, maybe just kind of an explanation, at least from our perspective, of what's been going on. I think everybody kind of understands the highlights, but there's a lot of data and a lot of opinion out there. So I think context is helpful for people. Obviously the recent market volatility, that's always a euphemism. Whenever we say market volatility, that means it's a euphemism for the market went down a lot. It sounds better than market went down a lot. But anyway, the volatility is obviously a result of the virus. And more specifically, and I think everybody knows this, more specifically, the steps that our government and governments around the world have taken to control the path of the virus, to flatten the curve, as it were, in terms of slowing the progression of the virus through the country. Now, that obviously has taken the form in stay-at-home orders for 95% of the citizens of the United States. That means that there's going to be huge economic damage being done for as long as those containment measures remain in place. The estimates that we're hearing are truly extraordinary and can sound very terrifying. They're bad. They're horrific. I won't mince words. Right now, I think the highest estimate, or the lowest estimate for growth, the highest negative estimate for the impact on second quarter GDP growth, gross domestic product growth in the United States, so hang on, is a 40% drop in GDP growth on the second quarter of this year. A lot of the forecasts, and this is almost impossible to forecast, actually, because you don't know exactly how long these stay-in-place orders are going to be in place. You don't know exactly what the pattern of reopening the country will look like, although we're beginning to get a sense of some of the plans that people are considering. So that these numbers are, they have to be viewed as kind of best guesstimates. 40%, I mean, we've never seen numbers like that on a quarterly basis. I can assure you those kinds of numbers they have no historical analog. It's never happened before, and we haven't actually ever shut down our economy voluntarily for, I think we're basically at a month, and this thing is going to last at least a number of weeks going forward. But the key here is, can you limit the economic damage to a relatively short period of time without permanently hurting the US economy? If you can, then a recovery, or actually robust recovery from this shutdown back into normal life, is actually possible. We think, all things being considered, it's actually the probable path that we're going to go through. Lots of dependencies. But the key is, you got to time box the impact of the virus on the and the steps to remediate the virus's impact. And then you have to make sure that period of intense economic pain doesn't permanently impair the US's economy to grow. And that brings into kind of, why has the government done what it's done? Why has the Federal Reserve done what it's done? And why has Washington collectively done what they've done with some of the fiscal stimulus? So if you kind of assume that 30 to 35% negative GDP growth in the second quarter is a reasonably accurate estimate of what you expect to happen in the second quarter, that would be about a $1 trillion hole in the US economy. Against that $1 trillion hole, the government has promised $2.2 trillion of fiscal stimulus, and the Fed has effectively pledged unlimited monetary stimulus to help the economy weather this, and actually with a real intent of making sure that this short-term economic damage doesn't become permanent. Well, how do you do that? Well, the first order of business is you save jobs, as many jobs as you can. Now, unemployment numbers have spiked. 16.6 million people have filed for unemployment in the last 3 weeks. Another few million are going to join those ranks tomorrow when we see the numbers for jobless claims. Truly, our unemployment rate now is probably at 15%, headed closer to 20% with those numbers. So it doesn't sound like they're really doing a good job of saving jobs. Well, how do you save jobs? Is you save businesses, right? You offer relief to small businesses. The way I think about it is, Seattle, where I live, was the first, I think we were the first county to stay at home. They issued that order 5 weeks ago in the city of Seattle and the county of King in Washington State. And immediately, I had to go in for a couple of things into the office, and I live in the city itself. And it was obvious that no one was on the streets, no one was going to the restaurants. Everybody else now sees that in their own neighborhood. So, if those restaurants that you go to for lunch when you go back to work are gone, or went out of business, then those jobs are gone. You're going to actually have to wait for another restaurant to start and to refit it and, redecorate it to their own taste. Then they're going to have to hire a whole new staff, and then, eventually you'll be able to go to lunch at a different lunch spot than you used to. But, the idea is it would take a long time for that to happen. So one of the things the government's tried to do is they're trying to save small businesses. And what they're doing is they're basically saying, we will give small businesses loans. They've carved out $350 billion in direct aid to small businesses. And those small businesses basically have to agree that if they keep the jobs, right, if they actually maintain people's employment, and that may mean bringing back off of unemployment for people that they furloughed. But if they do that, it's not a loan, it's a grant. The money is theirs. They don't have to pay it back. And you get a real sense there that is the focus, is to save jobs, save the pipes and plumbing of American commerce, so that when we emerge from our dens of self-isolation, that our normal lives are there to greet us. So there's really an intense focus on small businesses. It's looking like $350 billion is going to not be enough. That program went live about a week and a half ago. They already have $290 billion in subscribed loans. That's an estimate, but it appears to be a reasonable estimate. There are lots of stories about how difficult people are having in getting the loans. And yes, some people are having difficulty, but $290 billion of pledged assets out of 350 is first large, and frankly, that's a very short period of time. So they're really, and they're gonna, if they need more, they're gonna add more. They've all said it. They may argue, and there may be a political debate in Washington, D.C., but ultimately we have every confidence that there's no senator, congressman, or president that wants to have lots of small businesses permanently closed because they were unable to get an agreement on how to actually structure the kind of saving bank loans and grants that those companies need. So that's one way. The small businesses are a huge employer in the United States, so that actually maintains kind of the pipes and plumbing and allows, once we go back to work, they can call all those people back if they already haven't done it from unemployment. Their workers can go to work kind of right immediately. They don't have to redecorate. They have to get supplies and fire up the grills, but relatively quick order, they can actually get going again. It may take us a while for us to be comfortable to go to restaurants as much as we used to, but we will eventually. We're social animals. We can't change our behavior. I mean, you're seeing all the stress, probably in your personal life and just generally in society. People are having trouble self-isolating, and that's because that's not what human beings are. Human beings are social animals. We want to be in the mix. Some of us more than others. My wife would say, I don't want to be in the mix enough. But the reality is that small business loans, the other thing they're doing is they're looking at industries like airlines, like hotels, cruise lines, which is interesting. I think they'll be turning their attention to energy companies as well, that are big employers that are just getting whacked by this massive demand shock to their businesses, and are in jeopardy of failing for any number of reasons, not the least of which is they need funding to get themselves through this process. And put it bluntly, do you want to be the guy that buys an airline's bonds today? Who's going to lend to them? And if they do want to lend to them, how much interest are they going to have to pay? And does that make their businesses viable? Those are the kinds of questions that they're obviously asking. And so part of the aid that's been in the CARES Act, part of that aid is aimed at those industries that are highly affected to kind of help those industries, those companies survive. People think, oftentimes when you start talking about that this is a corporate bailout, kind of maybe. I don't think there's an equity shareholder. Many equity shareholders in these companies are going to feel really great about the bailout. Most bank shareholder companies during the global financial crisis did not feel good about the bailouts. The famous story was in Bear Stearns. A year before Bear Stearns failed, its stock was pricing at $150. The initial price that shareholders of Bear Stearns got was $2. It ended up going up to like 8 or 10, I think it was the final number. But 150 to 10 as a shareholder doesn't feel like you got bailed out. That's not the goal. The goal is to make sure the jobs aren't destroyed. So they're trying to make that happen as well. So that's one way the government's trying to stop this, this massive, hopefully short-term demand shock, which is what staying at home is, that there's an incredibly low level of demand for goods and services. Well, most goods and services, or a lot of goods and services. The other thing they're trying to do is they're trying to make sure that we, consumers, 70% of the economy, basically don't have to permanently impair our ability to consume in the future to get through this rough patch. So if you think about it, if you're an unemployed person and the only way you can feed your family in this rough patch is to drive up all your credit card bills to maximum balances, then once the economy gets back to normal, you're not going to be able to consume at anywhere near a normal level. You're going to actually have to pay back credit cards and get your kind of fiscal house in order before you can go back to consuming. Those kinds of recessions are very long lasting. That's what we saw in the global financial crisis. That was a consumer-led recession. And it took the consumer a long time to get their fiscal house in order so that they could actually start resuming a more normal consumption pattern. In fact, one would argue they never actually did in the cycle from 2009 until February. But you don't want you don't want to have people have to go into massive amounts of debts. And so what do? Well, you improve unemployment benefits. $600 a week in unemployment benefits, which is being what the U.S. federal government is subsidizing the state plans with, that represents a pay raise for 1/3 of U.S. workers. So it's actually a meaningful amount of money, on top of which they're sending checks for those that earn $70,000 or less. They're sending checks of $1,200 per person, $500 incrementally per child, to individuals. And the whole goal there, again, is to make sure that they don't have to put themselves in massive amounts of short-term debt, credit card debt primarily, to see themselves through this very difficult economic times. Ultimately, it's the success or not, the lack of success of those programs that are going to determine kind of where we go as an economy. Our view is that they're broadly, those programs, not because they're perfect, right? They're not perfect. There's all kinds of structural and practical problems and speed problems with all of these. So all those criticisms and those complaints you hear, I'm sure, are all valid. So they're imperfect, but what they got going for them is they're massive. They're huge. You know, a $1 trillion hole with $2 trillion in fiscal relief is you can make a number of mistakes with the $2 trillion and still have kind of a reasonable expectation that the goal is going to be effectively achieved. And that's kind of where we think is going to happen, is that they're going to be able to keep consumers generally in pretty good nick coming out of this, so that when they return to their normal lives, they can kind of go back to living their lives normally. You know, they haven't gone into a lot of debt. And if that's the case, they probably have some pent-up demand, right? You know, once they feel comfortable eating out in a restaurant, you know, they'll do it hesitantly maybe the next couple of times, but then they're going to do it a lot because they haven't done it for a long time. You know, kids are going to want to go to McDonald's and play on the play toy if they're anything like my kids were. You know, so that's kind of a pent-up demand. And again, if the pipes and plumbing of the economy are there, we think that actually that pent-up demand will also be aided by the fact that you have a 2.2 trillion, by far the largest fiscal package ever approved by the U.S. government and delivered by the U.S. government in history by a long way. So I think you've got massive fiscal stimulus kind of as a pushing, you know, the economy. The other thing you have is just massive monetary stimulus that's pushing the economy. So that in that case, so our view still is, and we're not going to talk shapes because, you know, if you get far enough away, a U looks a lot like a V. So I think shapes, the discussion of what shape is the recovery going to be, is not a really good and fruitful conversation. You know, but the reality is that we think the government will be reasonably successful, and that there is every chance that a robust economic recovery can start in the second half of this year. Probably the most troubling, you know, aspect of that view is that's kind of consensus right now in our industry. So that may give you comfort. It always makes a guy like me nervous when most people agree. Those are the things that kind of oftentimes can make you a little uncomfortable. But I think broadly, they got it right. And Europe's, I mean, just everywhere in the world, if you look at it, there's been $7.9 trillion of fiscal stimulus pledged by the governments of the world in response to this crisis. That's about 8% of the global GDP. This is, you know, policymakers have responded hugely. The ECB has said there's no limits to what they would do to support their economies. The Bank of Japan was already said no limits anyway. China is doing a lot of things. And I think China gives you hope, right? Because China, if you look at what's happened in China, they were the first ones to have the outbreak. They, you know, how successful they were in containing it initially is obviously something a lot of people want to debate. But it's very clear that China's going back to work. You know, and these are things. These are not Chinese statistics that the official government's giving us. These are hard data, like coal consumption to create electricity. They don't. I mean, you know, people sell them that coal. They know when that's actually happening. You're seeing a lot of like CO2 in the air, which is interesting because carbon goes into the air when economies are functioning at full force. the level of CO2, which had gotten lower in China because nobody was working, is now moving up. Those are things that are kind of hard evidence that the Chinese economy is not back to full strength, but it's getting closer and closer. And probably by the end of this month, will be awfully close to strength. So I think that is kind of the expected economic outlook. And remember, the stock market tends to start moving up before good news actually occurs. And we've already seen a very significant rally off the bottom. The bottom in the US stock market was on March 23rd. It was, I think, 2191 was the intraday low on the S&P 500. I mean, we are 20+% above that number now. So there's been a pretty significant rally off the bottom. When we were at 2191, we were down about 36%, give or take a nickel, from the February 19th all-time high. Just think about how fast that was, less than a month. By the way, fastest bear market in history. This thing setting land speed records for all kinds of things, but fastest bear market in history. But you've seen a pretty pronounced bounce. Now, whether that bounce, that 2191 is in fact the market low, kind of depends on whether or not the America gets back to work in a reasonable fashion. One of the questions that people asked was, if the stay in place goes to the end of May, what does this do for markets? Probably not a great deal is my answer. The market's expecting the stay at home to be largely in place. I mean, you never know exactly what the market, because that's us collectively, and you never know exactly where the market's thinking. But right now, I think the market's expecting the stay at home orders to go into May. Maybe not all the way through May, but into May. And the key of how much of a market impact that's going to have probably has to do a lot with the coronavirus curve, this curve flattening. Because right now, it's pretty established that there's a trend in the US and in Europe where, both of them were kind of fighting at the same time, the massive outbreak. In both cases, the curve is flattening. Kind of consistently across the board in every region and every hard-hit area. And in some areas, the curve is not even, it's now becoming downward sloping, like in Spain and Italy. Things are no longer getting worse at an accelerating pace. They're getting worse at a decelerating pace, which is kind of the key to eventually things getting better is that you got to stop getting worse quickly. So that's happening, and I think so. I think if it lasts to the end of May, I don't think the market's expecting it to. It's definitely expecting it to go into May, and if it goes through May, but you are seeing continual curve flattening and a better and better handle on the virus, I don't think it'll have a huge market impact. One of the questions is kind of where do you see opportunity? Well. Going into this sell-off, we thought the U.S. equity market was very expensive. When we got down to, down 36%, we thought the U.S. market may actually be even a little cheap, but close to fair value, maybe even a little cheap. Down about 20% from the highs, kind of where we're at now. The U.S. market is probably awfully close to fair value, but that means that you'll probably get a reasonable return for owning equities. But what has happened is that in this market sell-off, the U.S. market fell about 21%, the S&P 500. Non-U.S. markets fell basically the same amount. In fact, the only difference between what happened in the rest of the world and the U.S. from a stock market perspective, from an U.S. investor's perspective, was the dollar had some strength. It wasn't really long-lived strength, but it was there. It was more technical strength than a flight to quality of the dollar. But anyway, the dollar did well. And whenever that happens, your non-U.S. investments have to now be repatriated with more expensive dollars. So if the dollar strengthened by 2.8%, that actually reduces your non-U.S. equity returns by about 2.8%. So if you look at the difference between what the U.S. stock market did and what everybody else did, it was all the dollar. The markets themselves, stock prices themselves, fell about the same everywhere. But non-U.S. developed stocks, so countries like Europe, Canada, Australia, Japan, those countries, their markets were pretty close to fair value when this whole thing started. So that means, you drop 20 some odd percent, you're cheap. Emerging markets we thought were actually quite cheap before the crisis, and now they look really cheap. So I think if you're looking for long-term opportunities, kind of investment opportunities, I think there's a lot of opportunity outside the U.S. The U.S. is much more attractive now than it was 2 months ago, but the other markets we think are even more attractive. The other area that I think is attractive is credit, principally corporate bonds. So one of the things that happen in this sell-off, as often happens, is that the difference between the yield of corporate bonds and treasury bonds that difference called credit spread widened dramatically. Going back, remember I asked you, kind of generally asked you the rhetorical question about, do you want to be the one that actually lends money to an airline right now? That's credit spread. When the market demands, used to be satisfied with airlines paying, let's call it 3.5% on a 10-year bond. When the market demands that those same airlines now pay them 10%, right? That is the spread widening. That's the cost, and that happened pretty across the board. There were lots of reasons for it, but the main reason was that people were worried that those companies might go bankrupt and default on their debt. That got to the point where we thought it was extraordinarily attractive a couple of weeks ago. It's still those bonds look attractively priced. There will be defaults, but kind of what's happened in the last couple of weeks is one of the things the Federal Reserve did was they said, not only are we going to buy investment grade corporate bonds, because they don't want these bonds to default, they want these companies to stay in business so their jobs are kept. They've actually said, we're going to buy high yield bonds, or junk bonds, high yield bonds as well. And they've never done that before. And again, the idea is that they don't want companies going bankrupt because they don't have access to capital. They don't have access to loans. And the reason they don't want them to go bankrupt is they don't want to lose the jobs. So we view those as pretty attractive. Treasuries are always attractive if things go south. The best performing asset in this market sell-off were U.S. Treasuries if you're a U.S. investor. Actually, globally, that was true. It was the best performing asset on the planet. And so there's always a case to be made to owning some Treasuries, but they are very expensive. But you're not owning them for return potential. You're owning them to protect you when things go wrong. And things just went really, really wrong, and they gave you protection. So I think credit looks more attractive from a return standpoint than Treasuries, but you should never really think you're buying Treasuries for their return. You're buying Treasuries for protection. They offered it, and we think they still can offer it in the future. So the kind of market outlook right there is I think we've seen an improvement. I think it can probably challenge the lows we saw on March 23rd if you see really negative news about the virus path, the curve not flattening, or if it becomes very clear, it becomes clearer and clearer that the steps to mitigate the impact of the virus are going to last a lot longer than the market expects. But I think right now those look like reasonable risks to be taking on in terms of investments. I will say, I've been doing a lot of these calls over the last few weeks, as you might imagine, and every one of them I said, remaining disciplined and rebalancing and staying on your policy is your best strategy in uncertain times. And for those clients that listened and did that when the market was down 36, they feel a lot better than they did, at the worst point in the stock market. They don't feel great because their stock portfolios are still down 20%, but 20% is a lot different than 36%. If I do my math right, it's almost half. So I encourage people to remain disciplined, and I will always remind investors that you have a plan, investment plan, exactly for times like this. And so in my mind, the best course for all investors, unless you are incredibly insightful and see things that the rest of the market doesn't see, and you're absolutely certain you're right, and you're right, which I've never felt I knew I was ever knew 100% certain I was right about anything, then sticking with the plan, I think, is always a good idea. But you've now got a sense of, another sense like we need another reminder of how difficult that can be. But again, we think that it will turn out in the end in a reasonably positive way. I'll stop there. I'm sure there are some questions. I'm sure I missed something.
Sure. So we did have one person pose the question about Warren Buffett. Apparently Warren Buffett is dumping large amounts of stock right now. And the concern is, what does he know that we don't?
I don't know. Yeah, well, and I guess I was trying to find some information about that. So Berkshire Hathaway, just to give a sense of it, I think going into this was the 6th largest company by market capitalization in the S&P 500.
Wow.
It's a huge company. So, I don't know what a substantial amount of equities are, but if he's selling $30 billion in equities, he's not selling really any equities. I think that this is normally the period that he buys, and you also don't know what he did at the bottom, right? He's shown historically remarkable proclivity to be able to invest when others are fearful, and so he may have actually bottom fished for some things, in the teeth of the crisis, and is riding them back up. I don't. And the other thing I think Buffett will tell you is that he doesn't believe a lot in market timing. So, and remember, not everything he owns actually went down. Some stocks that he owns are actually doing just fine. So I don't think he knows anything everybody else doesn't know. And he's never, ever been one that spends a lot of time thinking about timing. What he cares about is buying things cheap.
Yeah. Okay. Okay, I think that you've covered through your talking and we've covered all the questions that we had pre-submitted for you. At this point, does anybody on the call have any questions for Erik? Erik, this is when it gets really, really quiet. And with a group this size, that's typical. So for all of the, yes?
I do have one question, and then I'm going to try to use Erik's broad perspective. As we're coming out of this sheltering in place, and how big of a hiccup before you see a negative ramification? And I'm going to use an example. Let's say one state goes ahead and says, yeah, it's fine. And then 3 weeks later, they got a spike that just freaks everybody out. Does the market react to that, or is some of that being planned in?
Well, yeah, first of all, yes, the market will react negatively to that, right? So the how you open the economy matters a lot. And if you look at kind of all of the plans that are being discussed, all of the experts that are opining about how you might open up the economy, the one thing you see consistently in every one of those is testing, right? So we have to have, in order to open the economy broadly, we have to have a very high capability to do testing, so that, to your point, when you see a spike in outbreaks in a specific area, because that's how this has manifested itself, right? Is that you get spikes and hot spots in certain areas that if you get on them early and contain that smaller area, you don't have as big of an effect, at a state or a national level. But I think the key is testing. There's a lot of, the risks, there are lots of risks to the view I just talked about. The overwhelming risk is the path of the virus does what you say, and it becomes kind of a serious issue because we're not, for whatever reason, we're not able to detect those outbreaks soon enough to be able to limit their impact and limit the steps that need to be to remediate it. And then the other kind of one, which is very much related, is if you go back to kind of 1918, my great grandfather passed away in the Spanish flu and influenza pandemic of 1918. That came in waves. And part of that, the idea that the way we can avoid that wave thing this time is that we have much better detection technology now than we did. So yes, that's very much a risk. And I think any opening plans is going to have the ability to do early detection of those kinds of spikes so that you can actually contain them in a town rather than have to shut down the whole state. Hopefully that answers your question. But if they're not able to do that, yeah, that'll be, the market will react very negatively.
Yeah, that answers my question. Thank you.
Okay, does anybody else have anything for Erik? No? Okay. Well, Erik, thank you again. Your comments were great, and really, really appreciate your insight, and want to thank everybody for joining us today. We look forward to your participation in next week's webinar, and we're going to be featuring the thoughts and insights from Kurt Riemann. He's from BlackRock. Again, the webinar will be on Wednesday at 3 o'clock. That's on the 22nd. And we really appreciate the trust and confidence that you place in us every single day. As your advisors, we take that responsibility seriously. And certainly reach out if you have any questions for us. We are all connected, right? We're emails and phone and webinars and all that. And so we're really working hard to stay connected with you. So please let us know if there's anything else we can be doing. So with that, again, Erik, thank you. And
thank you for having me, Marty.
You're welcome. You're welcome. So everybody stay well, and talk with you next week. Bye.
Bye now.